Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to share some of our opinions when it comes to inflation, the Bank of Canada, the monetary policy, what's going to happen with interest rates, things to consider, especially if you're a first-time home buyer looking to get into the market, whether you're choosing to go fixed or variable, what are things you should consider when it comes to push and pull factors. Stay tuned, we'll be right back. Once again, I want to thank everyone for their continued support, for watching our videos, our Finance Friday journey, as well as our financial education and literacy through the month of November and onwards as we push forward to help bring information to the forefront for a lot of consumers, a lot of buyers who are out there looking to make a decision or not sure exactly, what they should be considering, what they should be looking for. So what we want to talk about in this video is some of our opinions and beliefs when it comes to inflation, how that's going to impact the Bank of Canada, and what that means for you if you're looking to get a mortgage or if you're in the real estate market looking to buy. And if you're a homeowner, if you're looking to build your wealth through real estate, what are the things that you need to consider? First and foremost, what I do want to basically advise is that anything we have a discussion about in this video should not be taken as direct financial advice to make that decision. It's just an educational component and a conversation that we're having to help educate and bring awareness for a lot of people that may not be familiar with how things work in the marketplace and how push and pull factors like inflation and Bank of Canada policy can impact real estate and the real estate market. So first and foremost, what I wanted to touch upon is the key driver right now for a lot of people, and we're seeing it in the news, is inflation. Inflation's at 4.7% CPI index, and that is up from 4.4% that we had back in September. So obviously there's a lot of alarm to be had. Now, what I did want to stress is that we still believe, and I am still of the belief, that it is transitory in the sense that although it might be here for a little bit longer than anticipated, we say transitory because of the fact that it might be here for 6-7 months, depending on supply chain and issues with getting those products to the shelves. As I said in a previous video, we can't print more ships, or even if we had more ships, we're having problems porting and getting those items from the ships into the mainland and getting them to the shelves where consumers can purchase them. So when we say transitory, we mean that once these items get to market, that we might see the prices come down for a lot of items that we're seeing increased in price right now. I know we're seeing our grocery bills go up. If you look at some of the statistics, meat's up 5-6%. You have a lot of stuff that's up more expensive than it was, let's say, the same time last year. So these are things that you need to consider. Now, how does inflation work? What does it mean? So now with what's happening out in BC, if you may be aware of, there was a major flood that basically closed out a lot of roads and some rail that is going to impact items coming in from overseas into the west and then basically going in mainland. So with those items, we are anticipating that we're going to see some extended inflation in some products that are coming that route. So that is something that you do need to keep in mind as well. And what inflation tends to do is, as I said, drive up asset prices, which means if you're in the real estate market, you've seen your homes appreciated significantly over the last 18-19 months. Now that is a direct drive from all the Bank of Canada, the federal government, the money printing, the access of money in the marketplace, devaluing our currency. Now, what does that mean when you look at inflation, you look at the Bank of Canada? What are the push and pull factors as we start to hear a lot of news about Bank of Canada projecting, interest rate hikes and so on? There's a lot of information there, and I always say to clients, don't just look at the headlines, read the actual articles. There's been some interesting articles in the Financial Times as well as the Globe and Mail when it comes to what is happening there. So one thing, Tiff Macklem and the Deputy Minister of the Bank of Canada are basically indicating that there's a little bit of forward guidance here. We saw in 2008 and 2011, when they increased the rates later on, that it sent a shockwave through the economy. So now they've learned that lesson and they're starting to try to give a little bit more forward guidance to the Canadian public when it comes to what they're planning to do. So this is really good because it helps us plan. Now, what I do want to stress is that even though they've given a timeline, the Bank of Canada has made it very clear that they're going to be outcome driven, which means we need to see strength in the labor markets as well as in GDP and the economy in order for them to make these decisions. The reason that they're saying that in Q2 of 2022 or Q3 of 2022 that they're planning to increase interest rates is because of the fact that that's when they think that the economy will be fully rebounded and able to basically absorb an interest rate hike, one or two, depending on what type of media you're following. So that is an important factor. Now, Bank of Canada is outcome driven. They need to look at the data in order to make the decision. So just because they say that the rates are going to go up in Q2 or Q3 doesn't necessarily mean that they are going to go up in Q2 or Q3. Now, I'm not saying that that is not going to happen or that will happen or that, we don't anticipate any change. What's important to understand is that the Bank of Canada needs to look at the labor force, the gross domestic product, which is what the economy is driven on. May that be energy as well as real estate, which make up about 50% of GDP right now in Canada. And they need to assess the situation on an ongoing basis. So this is the whole reason why they're giving us timelines to sort of say, hey, as soon as the economy is where it should be, we will see interest rates go up. The question will be is what will happen when those interest rates go up? How will the economy respond to it? And what will happen afterwards? So basically what I want to dictate in this video is to sort of have that conversation for people that are in a variable rate mortgage at the current moment, and not to panic and lock into a fixed rate mortgage, because you're going to leave money on the table. So right now, because the bond market has gone up and they're pricing in the inflation, we've seen fixed rates, 5-year treasury bonds go up to the point where we're seeing, fixed rates hovering for anywhere 2.6%, almost 3%, depending on where you are, depending on what type of product you're looking at, in opposition to the variable rate, which we're seeing at literally 1.3 to 1.5%. So there is a significant gap in between the two. Now, a lot of clients are opting to go into the variable rate mortgage because of the sheer fact that there is a 1% discrepancy, which can equate to, on average, anywhere from $200 to $300 a month, depending on the size of your mortgage. And that is leaving money on the table, because what we're saying to clients is, let's say the Bank of Canada does decide to increase their interest rates in the second half of 2022, that's 6 to 8 months from now. You could be potentially leaving a lot of money on the table, and then with a variable rate mortgage, decide to lock in when we start to see what happens. But even at the current 1% plus discrepancy between a fixed and a variable rate mortgage, right now the Bank of Canada would have to increase it at least 5 to 8 times in order for you to be at the same position that you're at now, potentially with your current variable rate mortgage, and obviously depending on your lender and the rate that you had achieved or got when you did your mortgage. So these are always things to consider. Now, when we look at inflation, we've seen home prices sort of go through the roof right now in a lot of the GTA in Ontario. That's where we're based out of. So that is something that is to be considered. And the Bank of Canada, as well as the government, are keeping a close eye on real estate. One thing that's also made some news in the headlines, and it's come out through a data study through the CIBC chief economist Benjamin Tal, is that 30% of Canadians are basically getting inheritance or money gifted down payment from Bank of Mom and Dad. And that is a huge factor, because even the economists are saying that this is going to be the biggest wealth transfer in Canadian history about to happen in the next little while. Now, for us, what does that mean? That means for a lot of people, a lot of baby boomers that have the ability to help their children attain the goal of home ownership, they're going to either put themselves in a situation to help their children get into a home or get into the housing market, which is going to put a lot of people that are not at the advantage to have that, maybe that leverage at home, or don't have the income to get into the market. And that is going to, I think, in turn, going to push the real estate market into a new direction, into a whole new price point. Because as we have aging population starting to, retire, maybe pass away, and the inheritance is going to go to the next, the next generation, these people are going to come into some money, and that's going to push, some home prices that are already in the higher echelons higher even more, and you're going to see more push into the luxury market, and that's going to drive up prices. But obviously it comes down to qualification, and we never want to put a client into a position where they're not going to be able to meet their obligations and get them a mortgage that they can't qualify for or won't be able to manage. In one of the videos we did last week, we talked about co-signing and guarantors and adding that person to the deal in order to make the deal qualify. There are a few options when it comes down to it if you're looking to get into the market. But we do want to present the fact that there is going to be a huge wealth transfer. We do see inflation. We see asset prices going through the roof, as we've seen through the stock market and we've seen through real estate, which, even if real estate goes up, let's say it goes up 30%, which we've seen in the last 19 months in certain locations, even if it comes down 20%, it will still be 10% more expensive than it was the previous year. And most importantly, what we say to clients is, if home ownership is a goal of yours, save, work towards your down payment, get pre-approved. Don't stop looking for a home just because you think that maybe now's not the time for you. You should always have a search going, talking to your real estate professional and your mortgage professional to see exactly when the opportunity comes that you're prepared to make a move if you're eligible and capable of doing that. So we hope you found this video helpful. I know there's a lot of information in this video, but we just want to have an open discussion with our clients and consumers and first-time home buyers, even our real estate investors, about what we see happening in the economy and how to dissect it. Obviously, you need to do your own research and come up with your own conclusions, but we want to leave the video there. I hope everyone's having a great Friday, and I hope everyone has a great weekend ahead. Thank you again for tuning in.